All right, what is going on, everybody? Today we're going to be talking about what happened in the market. I was at school today and I read a report actually coming out from Reuters about Partners Group leading to in my opinion, the overall decline in the market today. That being a private credit scare once again. No one wants to hear that. That's been kind of the shadow surrounding the skies of the AI trade for a while now. It's been kind of shoved under the rug because we've had, hardware booming like absolutely crazy, AI kind of booming as well, all this euphoria, and no one's kind of talking about it. So when something, brings light back onto that deep, dark shadow of the private credit woes and worries, it can spook markets. And as we can see here by today, looking at the heat map on TradingView, it was not a great day. Almost a lot of things were down, but, hopefully if you pay attention to the channel and all your research, you know that we're very bullish. CPUs are very bullish semis right now. So AMD and Intel went up like crazy today. Great calls on that. Same with SanDisk, Micron, all those great companies. But overall, the market was down. I believe the SPY went down about 40 points on the day intraday. So, not a great day for investors. That being said as well, I just really want to say thank you to this one guy that commented on my video, Harsh Erie 7591. Really appreciate it. In the beginning of my video yesterday, I said the first 5 people who, comment on this video saying they subscribe to Aria Research and I get the email confirmation from them, I will comp them for their entire life free of Aria Research. And I did that for him. Just want to say shout out to you, man. Thank you for watching videos and showing the love. I really do appreciate that. And if you don't know what Aria Research is, it's just this equity firm me and a few others have created, like-minded individuals, where we write theses that we believe are true. We're going to be adding some new features, so make sure you stay tuned for that. We're going to be adding, daily trade boards, not financial advice. Make sure you do your own research and do your own due diligence. And we're going to be also adding, within that trade board, options chains too. So options trades, rather, credit spreads that you could do, diagonal spreads, all that good stuff that, we are kind of looking at. So if that's something you're interested in, advanced options and advanced strategies, make sure you go check that out and lock it in. This is going to be very helpful for you. But yeah, just want to say shout out to that guy. And we have 4 more slots open for the free comps. So if you're interested in that, make sure you go subscribe to Aria Research. Anyways, I don't want to waste your time. Let's jump into what caused the markets to crash. So firstly, the trigger was very narrow and specific. It was a firm called Partners Group, which is roughly a $185 billion Swiss alternative asset manager. They put a gate on its flagship Global Value Fund, okay? That is an $8.6 billion evergreen, vehicle. And the gate means investors who wanted their money out cannot all have it. So redemption requests had jumped to almost 10% of the fund in a single quarter. That is absolutely insane. So people were wanting to pull their money out. And redemption requests, they jumped to 10%. Double, actually, from the 5% the fund normally allows out the door. So they slammed the window shut, essentially, on that. The stock got destroyed for it. So if we go to CNBC here, we saw the stock Partners Group Holdings, AG, down 16+% on the day. Absolutely got destroyed for it. Partners Group, they were down at some points like 18% and hit a multi-year low, if I'm not mistaken. And it was, it did not stay contained. KKR also dropped like crazy too. So if I have this graph that I want to pull up here, kind of showing the sector-wide, issues, KKR was down about 5.7 or 6%. Blackstone fell about 5.5% too. Ares dropped 5%. And over in Europe, we had EQT and CVC. Both fell 6+% too. The entire alternative asset management complex got repriced in one session. So as you can see here, one thing these guys all have in common is wink, wink, nudge, nudge. They are all private credit companies. And you may be wondering, you see our boy CoreWeave here. Why did it fall 6.2%? I will be talking about that a little later, but I just want to let you know, if you read my Aria Research paper, then you understand CoreWeave has a lot of debt, okay? These neoclouds, they operate in the, build and debt out kind of sense is what I like to call it. They debt and then build. So these guys have a lot of debt and their collateral is GPUs that depreciate, right? So you may be seeing where I'm going with this, but they are funded primarily through private credit. And I kind of just want to talk about how this all started, right? So, the read on the street from today was, that the redemption pressure that has been sitting quietly in private credit for several quarters is kind of now spilling over into private equity. So that's another issue. In other words, the market did not see this as, one fund's problem. It saw it as kind of like a contagion, of like a disease kind of broadening out into not only private credit, but now equity to private equity. So that's a little bit of a shame. Second, there is a cloud already hanging over this specific firm that we were talking about, this big shadow. Back in late April, a short seller put out an order alleging that a big chunk of the assets inside this evergreen fund might be mismarked. And they made a comparison from this firm to Wirecard, which if you guys don't know what Wirecard is, it's probably one of the worst things you could be compared to as an asset manager. Essentially what Wirecard is, if I'm not mistaken, it was this big German company that committed a lot of fraud back in 2020. They got busted for it, and hopefully the guy's in jail for it. So I believe what happened was Wirecard, they were actually writing assets down on their sheets that didn't exist. So they had about $2 billion worth of assets that weren't real. And that's a big problem. So they got compared to it, which is bad. And then the company is actually suing the guy over it, calling it, over defamation for comparing them to Wirecard. But you put a gated fund on top of an unresolved, mismarking accusation related to their funds. Now you got this big, big volcano ready to explode worth of bad sentiment related to them. So as we saw, that kind of related to Partners Group going down 16%, but it was a little more broader than that. You could attribute it not only to this private equity issue, but broadening out more. But you could also attribute it to, we just had this massive run up on the S&P and the broader indexes. And we're seeing a lot potential profit taking, maybe some risk off trading going to Broadcom's earnings, kind of stuff like that. So it's not all related to it, but it does make you wonder when you see, a lot of these companies related to private credit and private equity that have a lot of stake in them going down to, like CoreWeave, as well as Nebius. Like, although they've had a great run up over this past few bit, they've been, you can argue that they kind of traded relatively flat, only down 3.4% on a broader day. It's not that bad. So they traded relatively flat in my view. But, CoreWeave did not. They were down about 6%. So, that's some things you got to keep in mind. But now, why does this connect to the AI trade? You may be wondering. I kind of touched on it briefly in the beginning, but I just want to touch on it again. So, if you're an AI and semis investor, you should care about this because private credit is the main financing engine underneath the entire AI build out. So after 2008, just a little history lesson for you guys. After 2008, actually, regulation in the government made it very expensive and hard for banks to actually hold, risky loans on their balance sheet. So, asset managers had to step into that gap, right? So this is where private credit kind of fills that. And you may be wondering why that is. As we know in 2008, what happened? There was a big crash related to the entire world and the entire market crash on these mortgage-backed securities and defaults on the housing market relating to this huge crash in banks. A lot of them had to get bailed out, and some of them fell under too, right? And a lot of these companies you saw draw down 70%. It was absolutely insane. But regulation kind of stepped in and said, you know what, we're going to prevent this from happening again. We can't afford the banks to keep making these risky decisions and risky, trades that they were kind of doing, right? So that's definitely a big reason why it's now being outsourced to private credit. And that market is now somewhere around $2 trillion, and it's kind of growing towards $5 trillion for the private credit. By the end of the decade, people are, aiming it out to be, so about 2029, it's going to be worth $5 trillion. And a huge slice of the AI data center boom and all those GPU stuffed warehouses that we've been talking about and we love on this channel is being funded with exactly that kind of debt, private credit. Okay? So when all private credit gets nervous, the cost of building AI capacity, it goes up. And, the availability of that total money kind of goes down. That's the transmission line that we want to talk about here. And I want you guys to really understand and hammer home on that idea. So a scare in, a Swiss fund that shouldn't really cause that big of a drawdown on the markets if you really think about it. It's just some random Swiss fund, But a big scare in a Swiss fund and a scare as well now in CoreWeave, these are all kind of connecting by the same funneling here. And I believe I have a chart. I might have gotten rid of it, but, it's all connected by the same funneling here. A lot of people call it circular financing of the AI trade. It's more so, kind of just the flow of the money. So right here is where the redemption gate sits. And that's where they saw the redemption requests rise from 5 to 10% in the second part here. So it all starts with investors, pensions and retail, investors kind of, and then it goes to private credit, the lenders lending out money to the companies who want to build out AI data centers. And then from there, those people who are building out the AI data centers get GPUs, goes to get money from NVIDIA, OpenAI, all that good stuff. And then it kind of, the circular flow of investing. CNBC had a great section on their channel talking about it. I could probably link it in the video down below, or the description down below, rather. It's great. They explain it way better than I ever could. But yes, that's kind of the circular financing of it all. And like I mentioned, this scare in CoreWeave, the reason why it affects CoreWeave is because CoreWeave, if you look at their balance sheet, they are backed solely by debt right now. Although if you look on a non-GAAP basis, so a non-GAAP basis of their earnings, not accounting for depreciation and amortization, they are able to actually pay back all of their debt. But I believe if you look at a GAAP basis, they are operating at a loss. Someone fact check me on that, but I believe that to be the case. It's one of the big reasons is the amount of debt they have, right? So that's one of the reasons why CoreWeave went down substantially today. It's kind of got caught in the crossfires, Nothing about the AI trade changed today. All the fundamentals are still intact. Everything is still the same about the companies, but this AI credit scare has always been an issue, and it's been looming. And that's one of the issues why the whole market kind of felt that today. Now, I want you guys to look at the two neoclouds here. Okay, so I got this cool chart here. I want to show you guys. I said that Nebius was kind of flat today. Even though they were down 3%, that's relatively flat in comparison to the run-up they had. So let's just go with that, right? So, looking at these two neoclouds, CoreWeave fell 6%. Nebius was down about 3%, but in terms of how much they rose up, they kind of barely moved over that, right? So, same sector. They are both neoclouds. Same day, completely different reactions. And you may be wondering why that is. And I kind of touched upon it, but to go deeper, it's because CoreWeave, amongst all the neoclouds, is the most debt-dependent name in the entire group. It funds its build-out, with high-yield notes, right, and GPU-backed debt that depreciates. Exactly the kind of financing, that gets more expensive when private credit decides to pull back, okay? Nebius, on the other hand, sits on billions in cash, funds far more from equity, and, just printed a profitable quarter on 684% revenue increases. So when the credit channel, fires on all cylinders like we're seeing today, the over-levered companies like CoreWeave gets repriced quickly. And, the people as well in that, kind of not bubble, but like sector with private credit, like KKR and all those other firms, Ares and Blue Owl, you can see a slight repricing in them too. And that's kind of the whole lesson here in just this chart, right? So, it's the financing structure. And it's now a differentiator. So the structure of how these businesses are financed can really be a differentiator for what investors want to look for. Power, it's the long-term constraint. Jensen Huang basically said at his keynote, I tweeted about it. Make sure you guys go follow me on X. But I tweeted about it basically saying that, compute is power from here on out. And those who have great time to compute are going to be getting in a lot of revenue. Or compute is power. Compute is revenue, rather. Sorry, guys. And a lot of people who have great time to compute and get around that, that's going to be the biggest differentiating factor for who wins and who doesn't in this AI race. CoreWeave has great time to compute because they actually get, NVIDIA GPUs first. They were the first ones to get Rubin 2026, I believe. Or rather, the H100, sorry. But they're going to be one of the first people to get Rubin 2027s. So, keep that in mind, guys. They have great time to compute. It's just they're very ridden with debt. So long as this, financing stays alive and they're able to, cover it, then they should be fine and they will be fine. Over at Aria Research, we've done the due diligence. We kind of looked to see, we predict that they will be able to sustain this. They will be fine. But overall, if anything kind of cracks, then there are more issues. We will keep you guys updated. But as of now, it's, kind of smooth sailing for them. But it's just worries, right? It's just sentiment worries. Like I said, power is a long-term constraint. Everyone always talks about it. Financing is another one that no one's really talking about. It's the one we talked about in 2025 and nothing now in this year. And it's the one that can really bite at any day if anything kind of goes under. It'll be, the first of many private credit scares that we see if this goes. And, moving on to my next point here, I just want to talk about, is this really a scare? Is it like a reckoning coming in? And, this is the most important one here. In my opinion, I don't think it's a reckoning yet. I think we're kind of in this area. We're more so leaning towards a liquidity scare. Redemption gate is kind of opened. People are getting more redemption requests and it doubled. It could be for a multitude of reasons. But because it's in the private credit, leaking over to private equity now, we're seeing that as a little bit more scary. So that's why it's not so in the green as it was in the beginning. But what we have to mention as well, guys, keep this in mind. A lot of these banks that are studying it way harder than I am, a lot of these banks that have, in-depth analysis capabilities for these banks and studying, private equity, private credit and the risks involved. they have revised down the amount of projected defaults in terms of a percentage for this year as it was in 2025. So that's kind of why we're seeing a lot of the alleviation in this private credit sector come around in the beginning months of this year. But now this scare in private equity bleeding over from private credit can, bring back some more fears. Overall, though, I don't think it's a reckoning yet. I think it's more of a liquidity scare. I think, an AI credit name like a NeoCloud or a big data center, entity, if they actually default on a loan with private credit or they get forced to write down their GPUs as collateral, I think that's momentum to bring it from a liquidity scare to more of a solvency scare or the solvency crisis. We'll be around here if anything like that ever happens. I'm leading towards red. Mark-to-market models become mark-to-market, right? And the financing tap tightens for everyone at once. Because this entire build-out, it's funded ahead of revenue, like I was talking to you about, that channel closing is a faster kill switch than any power shortage. Remember what I mentioned in my equity research paper regarding, IREN and Nebius. These guys are funding on future revenues, right? On future contractual agreements. So if anything ever falls through, how are they supposed to pay for that revenue? They're going to have to mark down data centers. They're going to have to mark down GPUs, leading to a collapse in not only private credit, but also the NeoCloud. So that is the risk. Now, mind you, these guys are doing business with high credit companies like Microsoft, Meta, and NVIDIA. So the odds of renegotiations or defaults is going to be very slim. And that's why these private credit firms are giving away, loans because they did their due diligence. It's like a high credit tenant. Like you're gonna, take them in. If you're, renting out, you're gonna take in a high credit tenant because they have a strong track record, right? That's kind of the analogy I used in that paper. Make sure you guys go read it if you're an IREN or Nebius investor. I think it's mandatory as well. It gives you great insight. It's one thing to just blindly invest. It's another to, invest with, trust and invest with knowledge. And this is, in my opinion, this paper will provide you with that thoroughly. But now I want to show you exactly what we are watching here. So exactly what I'll be watching. And I want to put these on your dashboard too, right? I want to put these in front of your face to show you what we both can watch simultaneously. First things first is the discount on non-traded credit funds. The spread on GPU-backed and high-yield AI debt versus safe investments. Because that gap is widening. And because that gap widening also, it's your real-time, fear gauge, right? And whether any of these AI borrowers, like CoreWeave, Nebius, IREN, start paying interest with more debt instead of cash, because that is, the classic tell that something could be cracking. Okay, so keep in mind in that. Make sure you do due diligence. Look at the company's balance sheets. Look at their, income statements, all their statements. Look at all that. And if they start, taking out more equity to pay for stuff, issuing more convertible notes, for instance, all that stuff to be able to pay for debt. And if they mention they're having trouble paying for debt, that can lead to solvency issues as opposed to just, liquidity scare. So make sure you keep that in mind, guys. Bottom line, today was definitely a sentiment relapse on a base that is already fragile, but it's improving this year. The cycle isn't rolling over by any means. Keep that in mind. The cycle is not rolling over. But the bull thesis is still very well intact. But the market kind of just reminded us in real time, that exactly where the weak point is. And that still can be private credit. And now, sadly, it's bleeding over to private equity. But we need more data, and time will tell. So it's not the chips. It's not the power that's the problem. It can be the financing, the money behind it, and how they're financing this whole stream. If this was useful, ladies and gentlemen, make sure you guys hit that subscribe button. I will keep tracking the credit signals and let you guys know the second the picture actually changes from liquidity to a solvency crisis. I'm not a financial advisor, and this is not financial advice. I'm just reading the tape. I'm just relaying the information. Guys, make sure you guys go subscribe to my YouTube channel. Leave a like down below. And I want you guys to comment down below. What do you guys think? Is this more of a liquidity scare or a potential buildup of a solvency crisis that we're seeing? And yeah, make sure you guys leave a like down below. Subscribe to my channel for more. Follow me on X at SoxManoa. And make sure you subscribe to my other research paper. We got a lot of new things coming out. A lot of great things I'm excited for. So make sure you guys go follow that. Anyways, guys, stay safe, stay smart, stay in the green, and God bless. Take care.